Hi, everyone. Welcome back to another episode of For What It's Worth. It's Jeff Hedley and Ben Hoeger here today to chat about the markets. Jeff, it's hard to believe it's September, right?
Yeah, my
The
God, this
fall.
year has gone very fast.
It's gone really fast. And I kind of think about that. It feels like at times we've covered entire years in a week or a month, however you want to reference that. But when you think about the amount of change or information that's flying our direction, it feels like we've covered years, even just since April. It feels like we've come a long way.
I think I'm going to celebrate 2 birthdays this year.
That's perfect. Well, maybe that's a comment to how this is aging us, right?
Yeah, I think it's a very good comment.
So, markets are at all-time highs, but at the same time, it feels like concerns are at
Yeah,
all-time highs.
yep,
And, I think everybody that knows you, Jeff, knows that you love history, right?
you, yep.
You especially love the history of the market. We rely on that a lot to help guide us through, a lot of the decisions we make. I think it's appropriate to kick it over to you and maybe tell us a bit of a story or some history of how this is coming in line with the context of today and what we're going through.
Ben, was kind of funny as we started talking about this call, really from a historical standpoint, it's hard to pick a topic.
Yeah.
We got the highest tariffs since the Smoot-Hawley Tariff Act in 1930. We're having unprecedented attacks on the independence of the Federal Reserve. The international trade order has been turned upside down with, drastically changing alliances. By the way, we have this thing called AI. So if we always, talk about the fact that the market climbs a wall of worry, I think this year will probably go down as the biggest wall of worry we've ever climbed. And, who would have ever thought that we'd be sitting here at the end of September with returns that we've seen, so far this year. But I think the thing that is the constant in the market right now is AI, and you can't ignore it. And the $1 million question that is on everyone's mind is whether these companies behind the drive in AI are going to wind up bursting in a spectacular bubble, or if they continue to grow at a pace that leaves the rest of the market relatively irrelevant.
And it's not even just the AI, right? It's the domino effect that's happening with everything that AI conversation is touching. I mean, this year in particular, but it's been brewing for a little bit, but this year in particular, it also feels like kind of this energy renaissance or whatever you want to call it due
Yeah,
to data centers. I mean, that's booming as well. And again, originates around the AI conversation, but that's getting pulled into the conversation also. It's kind of like this two-headed monster, if you
yeah,
will.
absolutely. And I think you can quantify the electric a lot easier than you could maybe put a finger on quantifying AI. I mean, if you don't
I
have
would agree because we've been underbuilt on power for a while. I mean, now we're just like piling on to the problem
correct.
of being under electrified, however you want to say that.
Yeah. And AI is just making it worse.
Yes.
And you could even, well, we're not going to talk about Bitcoin. You could throw Bitcoin in there and the mining of Bitcoin and the power that takes, so it's the grid is getting hit from two different areas. But we're going to keep this today to AI because that is a big driver of the financial markets right now. And, I always say that history is a great prognosticator of the future, but as a whole, people fail to pay attention to it. And this kind of comes back to, those 4 words that we hate, which is this time is different. We can say circumstances may be different, but the outcome rarely ever is. And, and I think this call is good because it's important for our clients to understand where our thought process is right now with the AI stocks and how we're positioned and why we're positioned the way we are. And, if we just contain the conversation to just technological bubbles of the past, there's lots of different bubbles, but let's just talk about technological bubbles because that's kind of what the AI is. And, that helps shape our thinking. And, I'm going to talk about some of the similarities. You're going to talk about some of the differences between what we're seeing right now. But I think clients will get a very good idea of hopefully where our mindset is. I was very fortunate to have been managing money through the dot-com crash. So I've got a pretty good knowledge of Wall Street's playbook when it comes to bubbles. And as you said, also, I love history and especially financial history. So I've studied a lot of the bubbles that we've seen in the past. And not shockingly, technology bubbles in particular all follow a pretty straightforward path. Now, they
Mm.
all center around new technology and innovation or change in the way we live our lives. And there's been four major technology bubbles that have burst from the mid 1800s to the 2000s. And they've been the railroads of the mid 1800s, really ran from about 1840 up to about 1860s. And that encompassed not only the United States, but in particular the UK. We had the electricity, telephone, radio, automobiles of the early 20th century. That probably is in a lot of people's minds. They understand that period of time and obviously the Great Depression. We also had the electronics and consumer tech of the 80s that kind of swept up Japan as well as the US. And we had the dot-com era of the 90s. And some common themes among all of them were that investors overreacted to the genuine productivity gains that they brought. And
Mm.
the subsequent bubble that burst did not prevent the technologies from sweeping the world. So those 2 points are very intertwined.
It's very sounds kind of familiar to today as well, right?
Absolutely, absolutely. And what was interesting is investors' expectations of the change that technology brought was absolutely correct. But the over expectations of the long-term returns is what the flaw was. And another lesson that we take away is that when bubbles burst, leading firms give way to startups, and many of the leading firms go broke. Yahoo, Dell, Corning, Nokia, Lucent, all are great examples of this from the dot-com bubble.
Yeah, any of them that are still around, maybe Dell wouldn't qualify this way, but some of those other names, if you're still around, you're a skeleton of yourself from
Correct.
your high days, right?
Correct. And it's important, especially with Dell, is Dell went under and then came back as a private company.
Mhm.
And so they did survive, but at a very strong cost to the existing shareholders, of the 90s. But, it's also important to understand that not all bubbles affect the economy the same. I mean, obviously, as I said, I lived through the dot-com bubble. It was terrible.
Yeah.
3 years, it just kept going and going and going.
It was so drawn out.
It was. And I'd rather have a quick correction than live through that again. But
Yeah.
what was really interesting is that if you just take the dot-com bubble out, it was very damaging to investors' portfolios, but it was not terribly damaging to the economy as a whole. I mean, we had a lot of other things that were happening during that 2000, 2002 period that hurt the economy more than just the dot-com bubble.
Yeah.
And, you know, flip side is the bursting of the railroad bubble created the longest economic slump we ever had in American history. So it's important to understand that just because a bubble bursts, it may or may not have an overall impact, on the economy as a whole. Another important differentiator, Ben, is whether you have political involvement in the bubble or whether it is purely technologically driven. So political involvement encourages investors to move as a herd, encouraging further
Mm.
investment, legitimizing that investment. And this involvement can come from either changing regulations or it could come from favorable taxes as it may relate to that industry. So history has shown us, though, that when there is political involvement, bubbles do more lasting damage to an economy than one that's created and driven by just investors.
Yeah.
Our current potential bubble, and I say potential, bubble in AI, was created through a technological innovation, obviously. But of late, politicians are adding fuel to the fire when we're seeing, our current administration is investing in this space. They're taking ownership in companies like Intel or a percentage of international sales, as we're seeing with NVIDIA. And it's not just us. I mean, we're also seeing that in Gulf countries that are the governments are pouring millions of dollars into AI investments as are other countries. Some of the things we're also seeing in our country is trimming regulations, or helping provide workers and infrastructure, for us to truly be the global leader in AI. So, in short, Wall Street's expectations, investors' expectations, current political involvement all have given us concerns that we are moving quickly toward a potentially unsustainable trajectory of these companies. The narratives around these companies are also very similar to the narratives we've seen from the past at the top of, markets, you know. So from a macro view, you can see why we are starting to have concerns. So that's the macro historical
Hmm.
perspective. You're going to dive in, and why don't you tell us a little bit from the micro level as we look at kind of these companies, in relation to what we saw with some of the companies in the 90s.
Yeah. If I could just make one comment before I get going, and Jeff, you and I have talked about this before. It was interesting. It recently came up, maybe in a Financial Times article. I can't remember. Anyways, it was calling out this idea of focusing on all the bad things or negative things going on out there versus the positive things going on out there in the world. And the article was commenting on the fact that it's so much easier to sound really, really smart when you're calling out the concerns,
Right.
right? But it's really, really hard to call out the positive things or why we should still be optimistic about our situation and not sound like a sleazy car salesman,
Yeah. And
right?
and that's a great point, Ben. And we go back to part of what of the comment I made. Every time we've had a technological bubble in the past, it has changed the world in a positive way.
Yep, for sure. So, with that being said, I guess that was my disclosure and my hedging of basically saying I'm about to say some positive things. So, don't get mad at me and be like, wow, Ben is just blind to the truth out there, because I think the comment here that I will wrap up with at the end is the fact that we can't get blinded by what's going on. We have to be eyes wide open, but that doesn't mean that we need to be scared of what's happening. We just need to be open to what's happening and very honest with ourselves. So we're going to try to draw some correlations here for a few minutes. So obviously, the concern is markets and some particular companies are at very lofty valuations. Right, that's everywhere. I mean, you can't make it more than a few days without reading some kind of financial media news and seeing a correlation drawn between 1999, the dot-com bubble, and today. It's everywhere. That was most of what I tried to focus on for our discussion today. Keeping in mind, like this is not an exhaustive conversation. We're going to wrap this up within the next like 5 minutes or so. It can't be an exhaustive conversation on this topic, right? So I'm going to try to hone in on some of the main points that we're going through. I think along with this thought, Jeff, you called it out earlier. There is a phrase that I'm consistently seeing in the reading I'm doing where people want to call this the quote unquote new normal. It makes me want to chuck my computer out the window every time I read it. I mean, it's silly, like this idea of a new normal. I mean, I've seen some really crazy things where people are saying we'll never have a recession again,
It's
or these valuations this is just the new normal, right? I have a hard time believing that. Back to your point of this time is different, right? It's just a different phrasing, but it's repeated and I think very dangerous. So, what I'm going to try to focus in on is, are these lofty valuations they're trying to call a new normal, is it justified? So, really want to be clear about our path forward and understand what valuations are saying. So I think when we look at where market valuations are today, and let's just focus on market valuations broadly. So let's say the S&P 500, somewhere around 22, 23 times earnings. All right. At that level, we're approaching those 1999 type levels, and people are calling that out as, gosh, this is approaching a bubble type territory. I'll draw some distinctions there, but before I get there, I think we have to ask ourselves, what are these high valuations telling us? It's telling us that investors have a lot of confidence about the future. And that's confidence in both the economy and then confidence in corporations' ability to generate more earnings and growth. Now, on the flip side, if we were at like a 14 times earnings, maybe like post eight, where the market was bottoming, and we saw some of the lowest valuations in history, what does that tell us? We lack all confidence.
right.
We're in a doom spiral. This is never going to get better. Our economy is terrible. We're never going to get out of this, and corporations will never figure out how to grow again. So those are the two wide spectrums. We're obviously at the high valuation side. So let's check in on that. The economy, I'm not going to talk much about it, but I'm just going to address this. The economy kind of feels like you can check that box that it's okay to be confident about it. We're in pretty darn good shape. The only thing you can maybe poke a hole in is maybe there's a little bit of squishiness or softness in the jobs data. Maybe. right? But there's a lot of weird things going on the job side due to some Washington policy as well. But that's probably about the only thing you could say that we shouldn't be confident about. So I'll spend the rest of the time focusing on the corporate earnings side, kind of getting back to this idea of justifying these lofty valuations. Something that came out in my research or my reading as we were thinking about this, the concept of operating margins. So operating margins, so we're all on the same page here, is simply saying how efficient are you at generating the profits as a corporation, right? We are at the highest level of operating margins we have, I'm going to say, ever seen. I don't want to maybe make that concrete. I did run a chart all the way back to 1990 up through now. We have never seen operating margins at this level.
Are you seeing are you seeing, Ben, any breakout though between, as we kind of talked about, the Mag 7 and the other 493, or let's say, if we add in some other stocks, the other 480?
So I did not pull a distinction between what are operating margins for, like, let's say the technology companies versus, let's say, an industrial company. So for example, if I were to think of just randomly as an idea, like a Caterpillar, let's say, well, is Caterpillar's operating margin better now than what it was in the early 2000s or something like that? I can't answer that question. It'd be interesting to look at that. What I can answer is operating margins for technology companies. So here's where we can draw some correlation, or really it points out why things are different, right? So I
Hmm.
can say it. Why
Hmm.
is it different this time? This is truly where it is different. Through my reading, this was the research that I was given through some research or some reading. They compared NVIDIA today versus Intel of 1999. So Intel was at the core of the 1999.com expansion, both on PC production, but also their relevance in the build out of the internet. Today, NVIDIA is squarely in the middle of the AI build out. So this was a great comparison that our research gave us. When I look at Intel versus NVIDIA, and this stuff is adjusted for inflation, right? So the amount of money NVIDIA makes today wouldn't be a fair comparison to the money that Intel made in 1999 unless you adjusted for some inflation. Today, NVIDIA has almost 2 times the operating margin of Intel in 1999. They are way more efficient as a business, way more efficient. A lot of that comes down to this idea of being a very asset light business. So that kind of comes back into question of when I say it would be interesting to look at Caterpillar. Has a Caterpillar maybe become a little more efficient? For sure, but that's still an asset heavy type business,
And,
right?
Ben, just for everyone, kind of explain that. You and we
Yeah,
don't.
yeah, yep. So good call out. So asset light in the technology world today is the biggest example that I could give you as a clear distinction. Intel was running their own fabrication plant, building the chips. NVIDIA simply designs the chips. They don't make a darn thing, right? That's an important distinction that you need to understand. So Intel was being drugged down by a lot of cost in operating their own manufacturing plant. NVIDIA manufactures really nothing, right? So that's a major difference. So, NVIDIA could have these massive operating margins, right? Absolutely massive. So is that skewing the numbers? For sure it is. It is skewing the numbers, but again, even if we're just focused on the S&P 500 broadly, it is still a massive component. So yes, it's going to bring up the averages, but I think it's fair to call out that distinction, right? So going back to this NVIDIA versus Intel type comparison, the other thing that we saw is NVIDIA is 3 times the size of Intel, inflation adjusted, 3 times the size and 7 times more profitable.
It's incredible.
So when people say this time is different, I think when you just use that as a decent comparison, it is different in the way that they are operating and how efficient they're operating and their ability to grow. I think those things are a distinction that, again, we don't want to be blinded by that, but it does feel like this starts to justify the fact that we're giving them pretty high valuations, or even if they're matching the valuations of 99, why is it not as concerning? Because they are radically more efficient businesses. So some people could probably argue it justifies an even higher valuation.
Yeah. And one thing that one thing that is interesting when we talk about valuations and things like this, and you interesting statistic, a lot of this comes on future growth, right? And this is
Yes.
what we do not have a crystal ball of knowing what the future growth is. And so much of this rests on this, right?
100%. So that's where I started the conversation with saying, like, we can't be blinded by this really shiny, cool object out there and get enamored with the fact that this is just going to go on forever. Because what we know is there is, like, I guess you could call it some kind of law of diminishing return, right? We've talked a lot about capital, CapEx or capital spending by these businesses. Because one comment I'll make, and I'll come back and finish that thought. But when we think about this CapEx, it's very much a circular thing amongst all these large technology companies. So here I got this example. So I'm going to give you these stats. I'm going to read here for a second. So NVIDIA invested $100 billion in OpenAI.
Hmm.
OpenAI signed a cloud deal with Oracle for $300 billion. Oracle bought $40 billion worth of chips from NVIDIA. Do you see where I'm going with this? It is one giant circle. It's like they're all in the same sandbox and they're all exchanging money. Now, that doesn't mean that that limits your growth, but you could probably draw some kind of conclusion that at some point they all have spent all the money that they want to spend amongst themselves. And it's you're going to start to kind of peak and go over the curve, and that's going to start to slow some stuff. Doesn't mean that you go backwards, but instead of growing at, let's just say, for example, 40%, you grow at 30%.
Yeah. Which is
That
normal,
changes that
which is
that
absolutely
very
normal.
normal. This is the maturity of the cycle, right? The question, and here's where again I come back to this idea that we're not saying this, we're at the end or this is the end. It just comes back to my comment earlier of we just have to be eyes wide open and understand and be very clear about where are we today. At the moment, the growth expectations are holding up.
Right.
So we don't need to panic. It would justify with how efficient they're running their businesses, their consistency in growth. If you look at the data points of, for example, with AI, the amount of prompts that are going through these systems, there's still a lot of building that has to occur to support what is happening. So, do we have runway in front of us? It sure feels like it. But again, we can't be blinded or enamored with this idea that it's going to go forever. And we just have to be very clear about where we're at.
Well, and I think that, one of the things I want to point out is, and again, this is kind of where we've had this experience of going through, the dot com. And I will tell you from someone that was managing money then, everyone was so highly concentrated in the stocks that were driving the dot com,
For sure.
highly concentrated money managers, individuals like myself, everyone. And when it blew up, nobody really was unscathed. And I think the difference of where we are today and what you and I are doing for our clients is we haven't eliminated our exposure completely to these companies. We're acknowledging that there are similarities of things at the past, but we're also acknowledging the fact we do not have the ability to call a top in these companies. So, what we're doing and what we're making sure of is that we're diversified. We still have exposure, but we don't have near the exposure of maybe what we had a year ago, or quite frankly, of where most portfolios were going into 2000, 98, 99. So,
Yeah.
it's acknowledging, it's, diversifying, it's limiting risk. It's also, admitting the fact that we can't call the top.
No, and that's where we gotta to your point, Jeff, to some extent, we gotta keep ourselves in the game. We can't just run away from it because we think there's a problem, because this quote unquote problem could be a year away or 5 years
Yeah,
away.
absolutely.
And then in the meantime, as these businesses continue to be so profitable and operate so efficiently, we need to be a part of that.
Yeah. And you and I have talked about this. I go back to a conference I was at in 99 in Dallas. And,
Uh-huh.
we had a lot of the top money managers at the time were on a panel. And one of the questions were, do you own Cisco? And I'm telling you, these guys were deer in headlights. And they all looked at each other. And one guy from Barron Funds said, you're damned if you do, and you're damned if you don't.
Yeah.
And I think that
That's
sums it up.
yeah. Mm,
Yeah.
so like I said, there's no way this can be an exhaustive discussion on this topic, but I think it points out where, to your point, at a macro level, where we've seen some
Hmm.
similarities and where we have reason to be concerned. And then when we dig in a little bit deeper and get more particular about where dollars are being held, and you start to try to draw some correlations to history, you start to understand where maybe there are some distinctions in history versus today and how these companies are operating. and maybe it is continues to be justified, at least at the levels that we're at.
Yep. And all we can say is stay tuned.
Yeah, absolutely, absolutely. So with that, I think that's a good place to wrap up here, Jeff. And I would just tell everyone to have a great fall season, enjoy football, enjoy family.
Yeah, and one last thing I'm going to throw in is a pitch for Morgan. We have for everyone here in Central Ohio, we got the Hedley Hager Group annual outing October 11th. We would love to see you there. We're going to have football, fun, games, food, drinks. And if you're not in Central Ohio, you can fly here. It's going to be a fun time.
Why not?
Right.
All right. It was great to see everyone. We look forward to being back here in a couple of months and chatting again.
Everyone be safe.
Bye now.
Bye.